Hello, greetings. Welcome to Dividend Blasters. This is our 113th video, and our topic today, QDVO, turning growth stocks into real monthly cash. So this income-based ETF is managed by Amplify. It is known as the Amplify CWP, Growth and Income ETF. So my objective here is to talk about why this ETF prioritizes growth. That's their number one priority, and their secondary priority is to deliver steady, consistent monthly cash flow. And they show no signs of NAV erosion. I got to tell you, when I see an income based ETF that prioritizes price appreciation or capital growth over income, which is very important to them, obviously, that tells me they hate NAV erosion. They want a growing fund, they want a growing asset. I love that. You know, if you've listened to my other videos, I hate NAV erosion. First, a little housekeeping. What I say is not financial advice. This video is for information and education, reflects my own opinions, research, and experience. As an independent investor for more than 30 years, do your own research and due diligence before making any investment decisions. So, as I said, their objectives, their primary objective is capital appreciation. It's an income based ETF, but that's their primary objective. Capital appreciation. Secondary objective, consistent, high current income. So last Friday, they closed at $29.59 a share. You can see that year to date, their price return is 10.42%. So they are capturing upside. Dividend frequency is monthly. They pay out every single month. Their current yield, trending 12 months, 9.08%. Expense ratio, 55 basis points. So every $10,000 you invest, you pay $55 a year, and you're paying for that options overlay. We're going to get to that in a little bit. The size of the fund, not bad. It's growing. It's not huge, but it's not bad. A little under $380 million assets under management. Seeking Alpha gives them a dividend yield and a dividend growth grade for the trending 12 months of an A+. So there's the 9.08% yield. Their last declared monthly dividend, 29 cents. So, and actually, let me just go back just a bit. You can just basically see that annualized, that's about $2.69 a share. So, looking at the history graphically, you can see that basically it's fairly steady. It goes up and down a little bit. They had a spike in January of 2025, and then they went down in February, and then they were fairly flat. They started going back up until June, and then they went down a tiny bit in July, a little bit more in August, went back up in September, and fairly steady in October. So, dollarized, you basically look at first dividend or distribution was about 15 cents a share. They're right now pushing up against 30 cents, and that's a little over a year. Here it is in a table form, and you can actually see the actual numbers. I don't see any adjustments to the declared amounts, but again, they started at around 15% in September of 2024. September of 2025, they're paying about 29 cents a share. So, price return year to date, again, a little bit less than the S&P 500, 10.42% versus 15.47%, but you're getting a distribution that doesn't show in this chart. We'd have to look at total return. Total return 19.3% for QDVO year to date, outpacing the S&P 500's 15.47%. How do they compare to some of their peers? So what I did, I selected a bunch of income-based ETFs that replicate and write options against NASDAQ 100 holdings and indices. And so that's what I did. Basically, what you see here is you see the NEOS High Income ETF, QQQY, Goldman Sachs's Premium Income ETF, GPIQ, JP Morgan Chase's JEPQ, Global X's QYLD, and Roundhill's QDTE. A little bit different here. Roundhill is a weekly payer. The rest of these are monthly payer. Let's take a look at how they compare size-wise. QDVO is much smaller. As I mentioned, they're about 380 million. QQQI, which I own and I really do like, and I like GPIQ a lot as well. Those are billion-dollar funds. QQQI is a little under 6 billion. GPIQ is a little under 2 billion. JEPQ is huge, by far the largest. They've been around the longest, 31.5 billion. QYLD, 8.1 billion. QDTE, a little under a billion. Full disclosure, I own QDVO, and I'm growing my holdings in that. I own quite a few shares of QQQI. I own even more shares, several hundred shares of GPIQ. JEPQ I owned for several years. I owned at one point more than 1,000 shares. I actually sold it and went into GPIQ mostly and moved some into QQQI. QYLD I do not own. I have seen evidence of NAV erosion. QDT I owned for a little while. I do no longer own that. I have seen evidence of NAV erosion, and I'll show you how I can tell in just a little bit. So this basically shows us how QDVO stacks up against these peers as far as its dividend yield. Again, they're 9.08%. QQQI is more focused on income. They have 13.5%. GPIQ is much closer to QDVO's 9.55%. I actually see their approach and their methodology around options more closely aligned with QDVO's. Maybe that's why I like it. And I like QQQI for different reasons. JEPQ, they have a little bit of a higher yield, 10.21%. QYLD, 12.73%. QDTE, I think, in my opinion, they overdistribute. That's 36%. And you can see the dollarized rates there. The only one with that's been around long enough that has a little bit of a growth streak is JEPQ, and it's 2 years. And they've been around, maybe 4 or 5 years. So let's look at price performance. So for 1 month, basically what I'm seeing here is that GPIQ, JEPQ, QYLD are doing very well. QDVO, not as much. QQQI, not as much. You can see the numbers, but when you spread out that duration, and it's really hard to really read into something with just 1 month of data. Ideally, you'd like to have a year, at least 6 months or a year. But let's take a look at 6 months. So we're looking at price performance. QDVO 18.84%, outpacing QQQI, which is 16.98. And I'm not surprised because their focus is more on income, but they do a good job of capturing upside. QQQI does. GPIQ, very well, 21.29%. Again, this is just price performance. JEPQ, a little bit back, 15.64%. QYLD is way behind. QDTE, pretty good, 12.99%. You're going to see a little bit of a difference in the separation with some of these when we look at total return. Now, if you look at year to date, check out QDVO. They're way ahead of everybody. 1 year, they're way ahead of everybody. Let's look at 1 year price performance. 14.44. QQQI's is 6, looks like 5.86. GPIQ is close, 11.13. JEPQ 5, way back, 5.97. QYLD is negative. QDTE is negative. Whoa. How can you be negative? Price performance in this market. Well, maybe they're over distributing. Maybe they're having to sell off assets and the value is declining. Therefore, the price is declining. Maybe. Here it is graphically. And this is for 1 year. It's everything I just said. Let's look at total return graphically. And this is 1 year. QDVO 26.41%. So remember, total return is price return plus dividends plus the option premiums that they collect through their options overlay strategy. QDVO 26.41%. It's outperforming everyone. QQQI very close, 23.25%. GPIQ very close, 23.42%. JEPQ is a little bit further back, 18.25%. QYLD, QDTE, they're back. They're a little bit back. QDT's not doing bad, but remember, they are losing price appreciation. And so for some folks, that's fine. Me, I don't really. That shows to me that they're collecting a lot of premiums, and very likely folks are dripping back in, and it's pushing the NAV back up, and it's pushing the price back up. And there could be something called NAV erosion. I mean, that's just my opinion. I am much more comfortable with a balanced approach, and I see a balanced approach with the first three, and I'm really interested in QDVO because a lot of folks don't know about QDVO. They know about QQQI and GPIQ and JEPQ. QDVO, to me, could be a hidden gem. So what is their active management strategy? How are they doing this? Their portfolio consists of large cap growth stocks that pay great dividends. And how do they select these stocks? They look at the different market sectors and they look for some balance. I mean, you might, some of these funds have algorithms that may do a straight across the board selection. Some of them are a little bit more calibrated. The fund managers take a close look and they make a determination. They look for balance across the different sectors, but they'll make a decision where they feel, based on market conditions, where they may want to weigh a little more heavily in one sector versus another. The portfolio can range anywhere from 20 to 40 stocks. They screen these based on a lot of key attributes and performance indicators that they feel are important to a good holding. They're going to look at earnings growth and cash flow, as well as the track record of the management team of the company. And very importantly, their options overlay strategy. It's a very tactical approach. So they're not going to place all their holdings up front in the money, at the money, or even slightly out of the money. They're going to take a sliver or a portion of their holdings, and very likely they're going to have those holdings with a strike price in a. Let me. I'm sorry, I'm getting a little tongue tied here. They're basically going to write an options overlay strategy where they're going to set a strike on a handful of their holdings, not all of them, and they're going to set that strike out of the money. And they're going to probably select various prices. They want to avoid assignment. They want to collect that options premium. They also want to retain those holdings, and that's why they do that. And that is why they're successful. Looking at their top 10 holdings, and this is just as of Friday: NVIDIA, Apple, Microsoft, Alphabet, Amazon, Broadcom, Meta Platforms, Tesla, AMD, and Visa. These are phenomenal holdings. I own stock in all of these individually, and sometimes I get a little disillusioned with Tesla, and I've actually reduced holdings in that. AMD, I've been holding on, and like, when's it going to take off? But I'm holding on to it. It's been pretty good this year. And of course, I have tons and tons of NVIDIA. So these are phenomenal holdings. And I love Visa. Visa's a steady performer, which I will never, ever sell. And here is basically a list of all the holdings. I'm not going to read all of them. You can look at them, but here you're going to see the number of shares, the last closing price, the market value, and the weighting percentage. I showed you the top 10. And here, maybe the bottom 10 or 15 are all options. And to me, they're all basically call options. Most of them are stocks. A few of them are indexes. And they're doing this to generate additional premium income. And they will add that to the monthly distribution that they pay out to us as investors. A little bit more of a drill down in this option overlay strategy. And I kind of talked about this. Again, they don't put everything up front in an options contract or contracts. They hold back significant amount because they want to capture upside, and especially in a bull market, that is smart. Some funds don't do that. They put everything up front because they want to juice that income. But the problem is it's very risky that those shares will be assigned and sold, and the market keeps going, and you've missed that upside. And what's the result? You will have to sell shares. You will have to sell shares. You'll have cash as a result, but you will have missed out. There's an opportunity cost. Um, and ultimately, when shares get sold, uh, the actual value can shrink of the fund. You have NAV erosion. Um, because sometimes you actually have to sell more of your holdings to pay out the distribution. So, for instance, some funds basically say, hey, we're going to pay out 25 or 30% annually on a monthly basis, and we're going to maintain that no matter what. And they give themselves no flexibility. When you lock yourself in, you have to sell when trades go against you because you need to maintain that distribution target. These guys don't do that. These guys are more flexible. Their focus is on growth while getting that high distribution. And that's why you saw that graph kind of go up and down a little bit. And it's a very gentle up and down. The calls are short duration, usually no longer than 1 month. You know, they're not going to do a 6 month or a 9 month options contract. There's a lot of risk in that because a lot of things can happen that you don't know. There could be a lot of volatility. Market conditions could change. There could be macroeconomic conditions that could change everything. So they're doing more than a week, but they're basically focusing on a month. They think that that is a good approach, and it's worked. And mostly these are out of the money options. Again, partial portfolio coverage. They don't put the entire portfolio, they put some of the portfolio in their options trades. This is interesting. The source of their income, 4 to 6% of the distributions annually come from options or the covered calls that they're selling. Their options overlay strategy. Um, and that's basically overlaid over the dividends that they collect from their holdings, which is 1 to 2%. So basically, 8%. They're actually doing a little better for the last 12 months, around 9%. But that's what makes up that 8 to 9%. It's mostly options, about 2/3 to 3/4 options versus a third to maybe a quarter fluctuating dividends from the holdings. And you know what? Why does any income-based ETF sell options or have an options overlay strategy? It's to really manage downside. It's to cushion any market um, downturns, and they're no different from that. But from what I see, they do a very good job of setting their strikes and also um, obviously selecting their holdings, setting their strikes uh, out of the money, and also being very selective and calibrated in how they execute their options overlay strategy. And as I mentioned, this is really important. They're not just selling hold calls on stocks, but they also give themselves the flexibility to sell against indexes as well. So looking at total return against their peers, year to date, they're doing pretty good. They're outpacing QQQI and GPIQ, uh, and they're outpacing everybody else. But 19.3% for QDVO versus 18.01 for QQQI and 18.69 for GPIQ. This to me is really the test against those two other peers. Now, you know, this could change. Market conditions can change. What is the real test of that? Real test is how the management team reacts and how they adjust their strategy. The key here is to be very flexible and nimble and be able to adapt to changing conditions because their objective is price appreciation, capital growth, and then secondarily, income, high income, consistent income. So that's basically it. And that is year to date. Let's look at it for 1 year. Wow, they're still ahead. 26.41% total return. QQQI is 23 and a quarter. GPIQ is 23.42. JEPQ's a little bit back, 18 and a quarter. QILD way back, less than 9%. QDTE not bad, 19%. Okay. But I tell you, with QDTE, I don't know. I've said enough about QDTE. That's just my opinion, not advice. So, how do they stack up against index funds as well as dividend growth ETFs. And now, keep in mind that these are different. We're comparing apples to oranges, but it is interesting just to see how they do. So, year to date, again, QDVO is 19.3. An index fund that replicates the NASDAQ 100, QQQ, 21.16. I would figure that they would kill any income-based ETF, but it's actually pretty close. So VOO, which replicates the S&P 500, QDVO is actually beating year to date. They are at 16.63%. SCHD, which I love, and I have, I have several thousand shares of SCHD. I've been building that holding for many years. 1.78% year to date. Total return. That's more of a defensive type ETF is what I think. But they've had kind of a tough year, I believe. DGROW, they've done better, 13.78%. VYM, and that's really like another SCHE, but they're doing much better, 13%. So they're close. But aside from QQQ, QDVO is beating the index fund ETFs and the dividend growth ETFs. Let's look at 1 year. We spread out that time frame a little bit. Wow, 1 year QDVO is beating QQQ 26.41% versus 26.02%. I am surprised by this. I never ever would have imagined this. They're beating VOO, which replicates the S&P 500, which is at 18.4%. SCHD is negative for the last year, minus 0.94%. DGROW 11.61, VYM 12.35. This is interesting, but I think with these dividend growth ETFs and also the index fund ETFs will really show how they perform is seeing them over that longer time horizon, how they perform for 3 years, 5 years, 10 years. But I'm doing this because I think it's interesting. And QDVO has only been around a little more than a year. So that's why I'm doing this. I'm not saying go ahead and sell all your QQQ or VOO or your SCHD and go into I'm not doing that because these things all do different things. So you want to be you want to look at this for what it is. It's an interesting look at how they're doing total return against alternative investments out there, alternative ETFs, different types of ETFs. So this to me I thought would be interesting. How does QDVO perform against some of the Bitcoin-based ETF and Bitcoin income ETFs? And I've done videos on IBIT, BTCI, and blocks. So QDVO year to date is actually outperforming IBIT. Wow. Now that's just year to date. So, if you were to look at if QDVO had been around for 10 years and you compare, if IBIT had been around for 10 years and had been tracking Bitcoin, IBIT would kill it. But we're just looking at year to date. BTCI, which is by Neos, it's outperforming. It's at 21.4%. Blocks, which I think is phenomenal. I just did a video on it. If you haven't seen it, I recommend you see it. It's my previous video. 51.6%. I think blocks is absolutely phenomenal, and it pays weekly. So let's look at the 1 year again. QDVO 26.41%. IBIT for the last year kills it, little under 62%. BTCI, it's killing it, 52.73. Blocks 51.16. Why is this happening? They're replicating Bitcoin and they are writing options against stocks and ETFs that own Bitcoin. IBIT actually owns Bitcoin. That's a very insurmountable challenge to go against Bitcoin these days. Bitcoin is phenomenal, and the ETFs that are responsible in their options overlay strategy or that replicate it effectively are hard to beat today. So anyway, I just and I'm not saying, hey, if you own QDVO, sell everything and go into IBIT or go. No. These things do different things. It's good to have this, and I own all of these. and I'm not moving anything from anywhere. I'm going to maintain my holdings in all of these. Okay, so really, to close, I'm going to say that QDVO, I believe, is a great income-based ETF. They're actively managed. I love their tactical covered call strategy. I love that they have short duration calls, 1 month, not longer, and that they're very select in what holdings they put forth to write their options against. So to me, that is a winning strategy, and they're doing really, really well. Um, and so, what's the result of this? They're going to deliver strong monthly income, reduce downside risk, and they're also going to give you, as the investor, great potential for capital growth. And folks, that is it. I thank you for sticking with me. I hope you found this video to be enjoyable and informative. If you would, give us a like, share the video with a friend, hit that notification bell so when the next video comes out, you know immediately. And if you have not already subscribed, we'd love for you to subscribe to our channel. If you are already subscribed, don't hit the button again. You'll unsubscribe. Don't do that. We're on different platforms. We're on X, Instagram, and Facebook. You can see the QR codes and the handles below. Check us out for great dividend and investment content. And in closing, just a friendly reminder, as an affiliate partner of Seeking Alpha, I can offer you discounts on the Seeking Alpha premium membership as well as its Alpha Picks. Premium membership, you get updated stock quotes, ETF quotes, and insightful analysis of just about every stock or ETF out there. I'm a longtime subscriber to the premium, and I love it. Alpha Picks, same thing. I love it. You're going to get 2 free picks every single month. Those picks typically kill the S&P 500. They got a great team, and they got a great um, quantitative model that they leverage in generating those 2 picks. You can see our links to these offers as well as the QR codes. And we will offer discounts, as I mentioned, for the premium, a 7-day free trial and 30 days off. If you decide you don't like it after 6 days, cancel. No harm, no foul. Alpha Picks, $50 off. The bundle, which is a little bit of both, $159 off. Again, you can see the links as well as the QR codes to read all about what we offer and the discounts. I already mentioned we're on different platforms. This video is brought to you by Dividend Blasters. So, until our next video, have a wonderful day. God bless.